Hi, I'm Kyle Rodder with this week's Investor Spotlight. We're in a global landscape of slowing growth and rising interest rates, so I want to look today at defensive and quality stocks and how investors can use them to protect their portfolio against an economic downturn. A quality stock, as the name suggests, is a company of high quality. It's defined by a strong balance sheet, strong margins, a big moat, and a competent management team. In Australia, companies like CSL spring to mind, while in the United States, the FANG stocks, the big US tech names, are often lumped in the quality basket. As the name suggests, a defensive stock is one that defends one's portfolio. These are companies that are typically outperformers in a downturn during the economic cycle and can often be found in areas of consumer necessities. Things like consumer staples, healthcare, utilities, and real estate sectors are all areas that are considered defensive. Investing in defensive and quality names has become popular recently because of the risks of an economic downturn as central bankers look to slow economic growth to tame runaway inflation. These are less risky investments and ones that can be potentially used to ride out any potential volatility during a downturn. CSL is one company with defensive characteristics, but also often gets lumped in the quality basket. It's a healthcare sector name, so typically holds up well during market downturns, but also possesses a very strong balance sheet as well as very, very strong market share. The company is a leader in the market and boasts a strong balance sheet with $6.3 billion of cash and cash equivalents. Now, the earnings of CSL did take a hit during the pandemic. However, the company managed to remain cash flow positive and has managed to maintain low debt levels throughout the period. The outlook for CSL is looking more promising going forward. Now, the current multiples are around long-term averages, but Reuters data suggests the company is likely to increase its dividend by 16% from an estimated $1.05 this financial year to $1.22 in the financial year after. Transurban is another ASX 20 listed stock with a market capitalisation of around $44 billion, which specialises in the building and management of toll roads. Now, the appeal of Transurban is its ability to pay out a strong and consistent dividend. Now, despite the company posting a loss in both 2020 and 2021 because of the COVID pandemic, it still managed to pay out a dividend of 46 cents and 30 cents respectively. According to data compiled by Reuters, Transurban ought to pay out a dividend of 40 cents this year and increase that by approximately 50% to 59 cents in the year following. Transurban generally won't deliver strong capital gains for investors, but the company's appeal is in that it's a lower volatility stock, having traded in a tight $2.50 range throughout the most part of the post-pandemic period. Microsoft is a ubiquitous name in the business world and one of Wall Street's largest tech names that is often branded both defensive and quality as well as growth. Now, technology shares have dropped considerably from the record highs registered in 2021, and Microsoft hasn't been exempt from this, losing nearly 30% of its value peak to trough. But in the shifting economic environment, the company's share price is showing signs of recovery. From a financial standpoint, Microsoft couldn't be more secure. It boasts $104 billion of cash on its balance sheet, and although that cash position has been worn down in the past 12 months, much of that is to do with a generous share buyback regime that the company has implemented to return money to shareholders. Now, like I said before, Microsoft continues to possess strong long-term growth prospects as well. Despite missing earnings and revenue in recent results, Microsoft's management painted a positive picture of the company's outlook, with growth in its cloud computing arm Azure a large driver of this. Analysts are expecting a near $2.60 full-year dividend from the company next financial year. Investors are confronting a more challenging financial and economic environment. As a result, understanding where money might be best allocated given this backdrop gives an investor the best opportunity to ride out this period of weaker growth. Companies that have qualities such as stable earnings and dividends, competent management, and strong balance sheets often outperform in times like these. While there's never a guarantee any investment will deliver its desired outcome, defensive and quality stocks can protect or even grow wealth during a market downturn.